I'm not really clear at this point what's going to transpire with the WeWork IPO, but I find the situation fascinating. For those of you who remember the late 90s, when basically anything could go public with the word internet in its name and could more or less be guaranteed a huge first day pop and then a subsequent rally until that all came to an end, um, I've started to see some signs of that sort of euphoria over the past years in certain what I would call the unicorn companies, the very highly valued private companies. The difference, though, is these companies are taking longer and longer to go public. And as a result, they're really, as I see it, they're not leaving as much on the table for the ordinary investors. And I think the two most obvious would be Lyft and Uber, where each of them had been bid up to these incredible private market valuations, and then by the time they came public, their IPOs were sort of duds, and investors at large were saying, well, where's the path to profitability? It's just fascinating because I think a lot of this has to do with investors with a longer memory, let's say the private investors, the ones who have access to these sort of deals of companies before they go public. I think they were betting a lot on the continuing euphoria. There's a cult of growth, and I do feel that a lot of that cult focuses on revenue growth to the expense of profitability. It's wonderful to grow your revenues, and you really can't grow your profits in a meaningful way unless you grow your revenues. But if you lose money more or less on every transaction you make, it doesn't really pay to increase your revenue because you're never going to increase your profits until you get that fixed. And for a while, the market was subsidizing these kind of companies with great revenue growth, but not a clear path to profitability. And WeWork, which at one point was seemingly valued at $47 billion, maybe the real poster child of all this. When you get down to it, WeWork is engaged in a very basic business. It's subletting. They buy or lease real estate, and actually in their case, a lot of the real estate is purchased by the chairman and then leased to the company, which has its own issues. But basically, they lease real estate and then lease it out to other tenants who want to use it on a shorter term basis. This is not a magic business here. Just as essentially Uber and Lyft had a better packaging for a taxi cab, this is a better packaging for a short-term commercial landlord. These companies exist. Regis Office Space just being one of them, that's been in this business for a long time, but without the cultishness that's accrued to the WeWork scenario. I think a lot of behind this, I'd have to sort of say the fingerprints of SoftBank are behind a lot of this, where you've had this company with this amazing track record, and I think people wanted to invest alongside SoftBank Ventures. And certainly the last round, if you invested, assuming a $47 billion valuation, and now we're talking about a $20 billion valuation or less, that's going to sting for a lot of the last round investors. I think in one sense it's been good. The market has gotten a bit more cognizant of the fact that if all these sophisticated investors are paying big premiums for the growth of the companies in the private market, are they really selling you something that's got as much potential as they had? Or have they more or less squeezed all the juice out of the orange by the time it comes public? Well, some of the most recent IPOs really have featured that. And I think that's been the downside of some of these companies staying private longer, the unicorn factor as it was. It's not to say you can't make money in IPOs. The people who bought Beyond Meat certainly have been happy for the most part, depending on when they bought it. But even there, with the stock trading in the 140s, people paid up to 200 for that one. So there's still some public investors who are getting clobbered as well. And in that case, again, they were very quick to sell more stock. So the lesson here is there's been all kinds of sophisticated professionals with better access to deals than the average investors, paying very full prices for the story, for the growth potential of these companies, without paying a ton of potential to the profit. And you as the investor have to decide, when these things are coming public, am I getting an opportunity to get all that growth that they see, or am I going to be the guy who's just left holding the bag as these guys use this as an opportunity to exit their investments? That's the key to the decision that you have to face with every one of these IPOs, and make your decisions wisely.